Welcome to our retirement planning educational webinar. Retirement planning is a vast topic. However, today we have selected the highest priority areas that are the most impactful to the final outcomes of your retirement. So let's move ahead. The key takeaways today are industry funding norms. We will lay out three key funding parameters that serve as beacons to guide responsible and prudent retirement planning. Secondly, investment returns. We will be focusing on investment returns as this is the single most important factor affecting the desirability of retirement outcomes. I'm excited to say that Serica will be using our integrated wealth planning modeling tool to demonstrate outcomes based on performance and returns. Thereafter, I will focus on the components that affect the returns and provide insights on how to maximize returns. Lastly, we will tackle some frequently asked questions, of which there are plenty, but we will select a few that are critically important to answer in any event. And thereafter, if there are further questions from the live audience, we will be glad to answer these as well. But prior to these three key areas, it's important that we lay the landscape on a few concepts, like what is the meaning of retirement and what funds are considered as retirement funding. The term retirement invokes different feelings for different individuals. It's often perceived as the time where you stop doing what you did for most of your life and do something else for the rest of your life, a very line in the sand kind of view. But PWM sees retirement as an evolution from working life to self fulfillment that can happen over many years and can start as early or as late as you want it to. There isn't an unhealthy obsession with the number 65. Retirement is an evolution of your lifestyle. We believe that it's possible to evolve into retirement. It starts with having the luxury of financial autonomy. This means that you could retire if you wanted to, but choose to work because you want to, not because you still have a huge monthly expenses or a bond to pay off or the usual costs of children education, etc. Now, financial autonomy naturally leads to working on your own terms, when you want to, and how you want to, and how often during the week you want to work. Maybe you want your weekends to start on a Thursday night and end on a Monday night. How wonderful would that be? But you need financial autonomy, and there's a way to get there. Your investments need to work for you. Working on your own terms then naturally leads to the pursuits of personal fulfillment. It's not possible to buy time, but it's possible to buy the space within the limited time you have. Working on your own terms opens up these spaces for personal fulfillment, whether it be sport, time with family, more travel, or whatever feeds your soul on a daily basis. Our job as wealth managers is to ensure that all your investments, your numbers, your plans, your strategies are lining up for this evolution into retirement. Now, having understood what PWM's definition of retirement is, let's move on to what constitutes retirement funds in our view. There's a common notion that retirement funds means pension and provident funds and retirement annuities, that is, retirement products. However, PWM's view is that any investment within your capital investment base that allows you to evolve into our definition of retirement is considered as your retirement capital. This means it covers investment properties as opposed to your personal residence and any other investment that could provide a return, whether it be capital or income. Now, having set the landscape to what PWM's view is on the meaning of retirement and what the meaning of retirement capital is, let's proceed to key takeaway one, which is industry funding parameters. What are the basics that any investor needs to pay attention to? There are three levers that affect the final outcome. The first lever is start early. Firstly, one needs to start investing from one's first paycheck. We assume that's around age 25, but it could be earlier or later. Often, younger clients tend to have other life stage priorities, but it's critical to invest first and then determine your lifestyle from the remainder of your disposable income. The second lever is investment rate. One needs to invest at least 15% of the gross amount of the paycheck. So, for self employed people, it would be your drawings from your business or the profits from your business. Or for salaried people, we are talking about the paycheck. For example, if the gross paycheck is 50,000 a month, you should be investing at least 7,500 a month at least. Anyone who increases this rate to 20% and then to 30% is surely going to accumulate wealth effortlessly. The key thing in increasing your investment funding rate is to ensure that your expenses do not keep up with the increases in your income. Create a gap, forgo that dream car for a few years, forgo other short term wants that your income increases in income can be very alluring for you to spend on, and you start creating that gap, you'll find that you will achieve your wealth increases effortlessly. The third lever is the return that you earn on your investments. Whether it's in retirement products or whether it's in other investments, you need to be earning at least the inflation of the country that you live in plus 6 to 7% per annum. So if it's South Africa, then you need to be earning 11 to 12% as a minimum, should be your return on your investments. Now, if you get these three parameters correct, this naturally leads to a possible retirement age of 65 with a capital base enough for a replacement ratio of 75% of your last earnings on the day before you retire. So, for example, if your last paycheck was 100,000 a month and you've adhered to these three parameters and everything has worked out ideally, at age 65, you should be able to retire on 75,000 Rand a month for the rest of your life without running out of capital. These three levers are interdependent. They support each other. And when one does not do its job, it puts pressure on the others. If one starts investments late, then the investment funding ratio will go up much higher than 15%. And the returns also will need to be much higher than 11 or 12% per annum. And vice versa, if you did everything right, but you've had bad returns, it will affect how much you will need to invest. And often most people cannot boost that very easily because of, you have other expenses and lifestyle expenses. Thus, we have chosen and selected the main lever that we consider as very important, and that is how investment returns affects your retirement outcomes. Having said that, I would like to pass on to Serika, who is going to actually take you through our interactive wealth modeling tool and demonstrate as to how returns projections and calculations are done and what affects investment returns as well, and how this affects your capital longevity and the sustainable living expenses and lifestyle during retirement. Over to you, Serika.
Thanks, Viren. In the real case that we're going to be illustrating, we have duplicated an existing client's actual retirement planning scenario and removed the names and any other identifying elements. So, this retirement planning exercise followed on from an initial analysis of the client's portfolios of products that were not managed by PWM at the time. And I wanted to touch on the results of the portfolio analysis before we head into the retirement planning exercise. So, firstly, the client's retirement portfolios had a long term average return of 7% per year. Now, this might seem surprisingly low to some people, but this is actually consistent in terms of most of the benchmarking that we've done on client portfolios not managed by us over the past 10 years. These retirement portfolios typically tend to be the conventional or traditional life insurance company issued RAs that have been mass produced for the retail market. And these retirement products are layered with distribution costs that detract from an already inadequate performance return. By contrast, the long term average of the balanced fund sector is actually 9.75% per year on average. Secondly, the linked investment portfolios, which consist of things like unit trusts and other non RA investments, had a long term average return of 9% per year. The clients' portfolios only had exposure to local markets and were very simplistic in nature. These portfolios were then compared to the long term average of the multi asset flexible fund sector, which delivered 12.03% on average per year over the same time period. So, in essence, both the retirement and the non retirement portfolios underperformed the sectoral averages by between 2 to 3% per year. So, why this is important to highlight is because a key feature of the software is that we are able to easily compare scenarios. Our interactive retirement tool has the ability to graphically illustrate results in a very effective and easy to understand way. This exercise can be done on an individual basis or on a joint family or household level. For this client, it was done on a household level for a family consisting of a doctor and a lawyer, both of whom were 47 years old, with one child who is currently in matric. They are both in respective private practices and want to consider the idea of retiring at age 65. The tool has a very intentionally simplistic interface, supported by very complex assumptions and calculations that run in the background. So as you can see, there are 4 columns of information that you can capture: assets, incomes, expenses, and liabilities, each of which have their own specific growth rates to project their respective future values. Now, before I show you the results of the exercise, let me quickly take you through the family's assets, income, expenses, and liabilities, because these inputs are identical in both the scenarios that I'm going to illustrate. In the interest of saving time, I'll be highlighting the underlying components of each asset, and the values will be on the screen for your reference. So, for retirement annuities, the total consists of the consolidated values of both of their RAs. Just to touch on the detailed assumptions here, there are inputs covering everything from investment return rates to maturity dates, with associated monthly premiums also shown in the expenses section. In addition, based on the type of product and the client's marginal tax bracket, the correct tax implications are also factored in behind the scenes. From their respective previous employments, they were both members of work pension funds, and this total of 900,000 represents the combined values of both of their respective preservation pension funds. The joint linked investments total of 1.1 million consists of a variety of unit trusts, assumed to grow at the portfolio's actual analysed growth rate of 9% per year on average. The doctor has a share portfolio, and both clients have tax-free savings accounts, bank savings, and endowments, where the consolidated totals are shown on screen. Another key feature of this tool is that you're easily able to distinguish between assets that have been earmarked as retirement funding assets versus surplus assets or assets that can be classified into, lifestyle or legacy assets. Thus far, all of the assets have been classified as retirement funding assets, but the vehicles, for example, have been excluded from the calculation of retirement provisions by being classified as lifestyle assets. Similarly, with the residential property, their joint residence has been classified as a lifestyle asset. This property has a small bond of about 200,000, which has been intentionally left open as a credit facility with small monthly repayments. There is also an investment property with a net rental, so after utilities and other costs, of 7,500 Rand per month. For incomes, from a primary income perspective, their combined monthly gross income is 250,000 Rand, with annual dividends being earned of R1,000,000, with the tool calculating the appropriate marginal taxes and deducting it behind the scenes. From an expenses perspective, the expenses have been stratified based on the different growth rates. So, for example, the bond repayment has its own interest rate and repayment term. The life and household insurances have been consolidated and shown together in this section. Their respective monthly bank savings and RA premiums are shown under the investment contributions section. General living expenses, so things like groceries, telephone, internet, entertainment, etc., tend to increase year on year by inflation and have been grouped together as a result. Medical aid tends to increase by about 12% year on year. And in terms of the medical aid, the clients will be paying for medical aid for a family of 3 until their daughter has completed her university studies. Thereafter, it will be adjusted to account for only 2 members. Utilities also grow at a rate of higher than inflation and thus are shown separately here. And the final expense covers the annual university fees for their daughter who will be starting next year. The tool also incorporates irregular expenditure or goals. In this instance, the client goes on annual overseas family holidays to the tune of 100,000 Rand per year, and they replace their vehicles every 5 years by trading in one of the existing vehicles and using the trading value plus an additional 400,000 of capital to buy a new vehicle. The comparison of the current scenario against the industry average scenario, which uses the sectoral average portfolio returns, shows a starkly different result. The current scenario shows that at age 73, the client's expenses will exceed the income that they are able to draw from their investments. Whereas if the portfolio simply earned the average returns of their respective sectors, in other words, nothing worse or better than the median return, the result is that the capital lasts a further 15 years to age 88, which exceeds the average life expectancy. As a reminder, the only change between the two scenarios has been the portfolio returns. The accumulated capital saved to date, as well as the ongoing monthly savings of the clients, is sufficient and in line with the industry norms and ratios that were discussed earlier under the ideal funding parameters. It is worthwhile noting that at retirement, the difference in capital is approximately 41 million Rand versus, say, about 66 million Rand, indicating that the retirement nest eggs look very different under the two scenarios. So for anyone who may be weighing the option of maybe retiring later against the impact of improving the portfolio returns, if I have to go back to the current scenario and extend the retirement date out by a further 10 years, so to age 75, you'll see that the capital still does not last until age 88, where you're running into liquidity problems at age 83. Alternatively, for anyone who may be weighing the impact of reducing your standard of living against the impact of optimizing your portfolio returns, if I have to quickly go back to the current scenario and if I have to make a few adjustments, so for example, if we do a more modest annual holiday, so an annual local holiday instead of an overseas holiday, if we have to lower the cost of car replacements, if we lower the standard of living, so let's say we reduce the monthly living expense by 50% or cut it in half, and if we have to, say, reduce the medical aid, and the client opts for a basic hospital plan as opposed to a comprehensive medical aid, and if we look at the results, we can see that the capital still does not reach age 88, and in fact, it runs out earlier. So the key takeaway here is that while the quantum saved towards retirement is of great importance, it is not the most important factor. It is glaringly evident how returns affect your retirement. But then, what affects returns? To delve into this, I hand back over to Virian.
Now that we've identified that the returns are critically important for satisfactory retirement outcomes, let's focus on how to maximize these returns. There are three fundamental components or cogs to the machine that generates returns. First, costs. The net return on your policy is very dependent on the costs of the investment. The costs should be reasonable and represent value for money. Excessive costs erode returns. The second component is asset allocation. Asset allocation refers to how your investment engine is allocated within any investment product. Different types of assets have differing characteristics in terms of performance and volatility. How you combine them in a portfolio is critically important to the final return. Decades of research conducted by some of the most reputable universities and institutions internationally have concluded that asset allocation determines 90% of the final gross performance. For example, let me present a typical market related asset allocation portfolio versus a defensive portfolio. You will notice that although the ingredients are the same, the weightings of each ingredient differ in both portfolios. The market related portfolio has a higher allocation to equities, both local and global, as represented by the orange sectors, and a fair chunk in alternatives. The defensive portfolio has a far greater allocation to income funds and bonds, and a lower allocation to equities. Backtesting these portfolios over a 20-year period reveals a return of 12% for the market related portfolio and 8% for the defensive portfolio. Sounds simple enough, just invest in the market related portfolio. But surprisingly, our observations of the industry point to a lack of precision in managing asset allocation. A huge problem in the industry is the sale of the product, which is deemed to be more important than what the engine looks like or what it should look like. I suspect there's a general lack of awareness of the importance of asset allocation. It's like the heartbeat of the portfolio, it needs attention. For most clients that we have onboarded in the last 5 to 6 years, we have observed cases where initial asset allocation is incorrect for the retirement objectives, age, and time horizon of that investor, but was never corrected, resulting in a huge amount of returns being left on the table. We also observed recency bias, where asset allocation is determined by what's recently doing well and not on pure financial principles that stand the test of time. A final word on asset allocation: it's important to get this right and to make sure it's always relevant. But we will explore the financial aspect of our actual findings in a few minutes. The last component is tactical portfolio management. This refers to changing and evolving the asset allocation to reflect changing market and economic conditions. It refers to small refinements like fine tuning and servicing an engine to ensure continued performance. There are times and economic conditions and market cycles that actually point to adjustments. For example, increase in equities or a decrease in equities, or an increase in the international allocation at a point where the local currencies are strong, etc. Making the three components interact and support each other is a simple way to ensure pleasing returns. Now, let's turn to some actual historical performance analysis done by PWM on retirement policies in the marketplace. A total of 160 policies were analyzed over a period from 2018 to 2024. A standard procedure at PWM is to conduct an in-depth analysis of existing investments for newly onboarded clients. This was the source of the 160 actual policies analyzed. When we look at the aggregated results, firstly, we found that the costs are generally 60% higher than necessary and detracted about 1.5 to 1.8% of the return via excessive costs. This is 1.5 to 1.8% per annum. The second common finding is that the asset allocation is often incorrect for that client's portfolio. It's either too aggressive or it's too conservative, or lacks international diversification or lacks equities. Asset allocation seems to be a very neglected area, and we found that on average it detracted from about 0.8% per annum of the return. These are the average results aggregated from 160 policies analyzed. We start with a median balance fund return of 9.75, and this is the benchmark that should have been achieved. If we take out the excess costs or excessive costs of minus 1.5% and less the asset allocation errors of, say, 0.8% on average, we land at around 7.45% per annum net return on the retirement policy. And that's what we've been seeing on the general policies out there in the marketplace. Thus, we conclude that there is approximately 2.3% per annum improvement that can be achieved simply by ensuring that invest via the correct channels. Unfortunately, too often we see new clients with products that are generated for the mass market with high commissions and distribution costs. This can be avoided. Furthermore, precision on asset allocation is so important, adding a further 0.8% per annum improved return if this is done correctly. Now, we are at the third and final key takeaway, which is the FAQs. Retirement planning is a vast subject, and so the breadth of frequently asked questions is a lot. And now we're going to slowly unfold these questions and allow you to briefly glance at it and absorb the typical questions that are out there, some of which may be at top of your mind as well. Whilst we await live questions, we have selected three most important ones to explore further. Firstly, for my age, how much should I have as an investment capital or retirement capital? Secondly, on retirement, should I secure a guaranteed traditional annuity or structure my own living annuity? What are the differences? Thirdly, how much income should I draw in retirement to ensure that my nest egg outlives me and my dependent? So, to answer these three very important and typical questions, I hand you over to Serika, who will present slides to answer these three questions, whilst we await further live questions, which we will surely answer if and when they come in. Thank you so much. Over to you, Serika.